Hello, welcome back and welcome back to myself as well. So a very good morning and I hope that you guys have a great and restful weekend. Welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be a brand new week, Monday, the 17th of March, 2025. So before we kickstart today's Daily Dose of Market Insights, as usual, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so as usual, let's have a quick recap what has taken shape yesterday in terms of, I would say that maybe over the weekend, last week, and also to highlight to you while away what are the key movement that has taken shape in the global markets for the week before this week, and as well as key data and events that has taken shape in today's early Asia session as well. So let's start with the performance of the US stock market on last Friday. So what you could see over here is that the performance of the US stock market on last Friday was rather positive. All right, so the SPX managed to gain by 2.13%, the Nasdaq 100 gained by 2.45%, the Dow Jones 1.65%, and the Russell 2000 2.53%. So if you look at the heat map of the S&P 500 on last Friday was almost in the green, but that is only potentially due to a short-term counter trend rebound that taken shape on last Friday. And still recall that while I was away for the entire of last week, on my last daily dose on Friday, the previous Friday, that means i.e. On the 7th of March, on the 7th of March, before I was away for the entire week of 10th of March all the way to 14th of March. On the 7th of March, I did highlight that the major US stock indices may be facing a kind of a corrective decline move, which it happened. So if you look at the entire 1 week of performance of the US stock market is almost in the red. And if you look at from a technical perspective as well, by looking at the technical charts of the US stock market over here, let me put it in, where is it? I think it should be, over here. So you look at from the S&P 500, yes, clearly broken down below the 200-day moving average. All right, very clearly 200-day moving average. So usually after a breakdown of 200-day moving average, there's some kind of downside momentum. So after the downside momentum, usually there'll be a kind of what I call short covering or potential tactical short-term intraday technical rebound that has taken shape on last Friday. All right, so very similar on the higher beta Nasdaq 100 as well. So this is the market that is more growth oriented. So any signs of a weakness and a leading sign of weakness or leading signs of recovery most likely will come out from the Nasdaq 100 first. Thereafter, it will spread over to the rest of the other major US stock indices, because this is considered as a growth index or a leading index or a high beta index if you look at from a quantitative point of view. So also breaking below the 200-day moving average as well. And even the previously lesser, or I would say outperform Dow Jones Industrial Average. That means, i.e., when I talk about outperform, it doesn't mean that it needs to be in positive. That means it fall lesser than the S&P 500 and Nasdaq 100, also breaking down below the 200-day moving average. The small cap Russell 2000 pretty badly as well, also broke down below its 200-day moving average. So very clearly right now, the trend situation has started to change for the major US stock indices, despite the fact that on Friday we see a rebound, but that rebound is likely to be only a minor corrective rebound. We in a potential multi-month corrective downtrend phase that may be evolving right now for the major US stock indices, as all that has broken below its 200-day moving average. All right, so that was, and also what led to this so-called acceleration of down move for the major US stock indices, because right now key political holders in the US doesn't seems to be bothered about the current state of the weak performance in the major US stock indices, that it potentially could lead to what I call slower economic growth. So in terms of financial markets, to dictate or to forecast where the economic growth will be heading for a particular country, one of the leading metrics will be looking at the performance of the benchmark stock indices. And based on the performance of these benchmark stock indices in the past 4 weeks or so, it seems to us that the odds of economic slowdown in the US is gaining traction day by day, and this has been pretty much been reinforced by the top political holders in the US. So over the weekend, US Treasury Secretary, he said he's not worried about the market and calls correction healthy. So this what it means that over here is that it is implied to us that the US top policy makers, be it the political holders, seems to be wanting to engineer a stock market correction. All right, despite the fact that they are pushing for this rather fluid US trade tariffs policy against the rest of the world. So that's coming from Secretary of Treasury, the Treasury Secretary Scott Bessent, and that happened on the weekend. All right, and last week, the Commerce Secretary over here, Howard Lutnick, defended President Trump's economic policy this last Tuesday, saying they are worth it, even they lead to a recession. Right, so it seems to us that the top, like I repeat again, the top political office holders in the US, based on the comments from Commerce Secretary Howard Lutnick, and over the weekend, Treasury Secretary Scott Bessent, who's saying that he's not concerned about the ongoing state of the major US stock market correction. They seems to be trying to engineer a potential economic slowdown in the US economy. All right, at this point in time, at the horizon, what is their ultimate aim? I do not want to actually we call it emphasize much about that, because it's rather sensitive at this point in juncture. But it seems to us that based on a technical analysis perspective, based on a macro perspective, and based on a political factor perspective, the major US stock indices seems to be evolving in a rather increasing odds of a multi-month corrective decline sequence. And on Friday, one key economic data also support it in this potential ongoing multi-month corrective decline sequence for the major US stock indices, was the rather lackluster University Michigan consumer sentiment flash data for March, where it actually plummeted to 57.9, way below market expectation of 63.1, and also way below the previous month of March figure of 64.7. So you look at the trend of the flash consumer sentiment data as compiled by the University of Michigan, the 57.9 flash data print for the month of March is the lowest one in the last 2 months or 3 months or so. So let's look at the trend over here. Okay, it's hang. Give me a couple of seconds. All right, so you look at the March figure, right? Okay, so it's the lowest print, 57.9, since 3 years or 2.5 years, I would say. And if you look at it from a technical perspective, it has broken below this major uptrending phase as well that has been previously in place since June 2022. All right, previously it's been in a major uptrend move, and last Friday deep plunge print of 57.9, pardon me, this is the preliminary figure or the flash figure for the month of March, has kind of damaged this major uptrend phase that was previously has taken shape since June 2022 previously. So very clearly, the plunge of this University of Michigan flash figure for the month of March indicate that US consumer is rather placing a gloomy prospect of US economic growth going forward, and consumer sentiment is a leading economic indicator. So what it means that retail sales and the services sector in the US may show dismal or lackluster performance in the next 1 or 2 months or so. All right, and what's interesting in its sub-component, because University of Michigan also pulled another, what you call it, a survey on top of consumer sentiment. So I call it the sub-component of it will be inflationary expectation 1 year and 5 year. All right. So the 5-year inflationary expectation market, the participants or the survey respondent expect it to tick higher to 3.9% from 3.5% that was printed in the previous month of February. So what we could see over here is that the 1-year inflation expectation jumped much higher to 4.9%. So if you look at the trend of the 1-year inflation expectation, that means survey-based expectation of where inflation will be 1 year from now. Okay, so if you look at this jump of 4.9% on Friday's data release for the March preliminary print on the 1-year inflation expectation compiled by the University of Michigan University in the US. If you look at the 10-year trend, it's the highest since almost in 3 years, close to about 3 years plus over here. All right, that's a steep jump. So what you could see over here is that consumer in the US is also pretty much concerned about higher prices of goods. That's going to be a hit to them due to Trump's rather fluid trade tariffs policy against the rest of the world. So what it means that over here is that potentially economic slowdown in the US because weak consumer sentiment, but however, prices of goods and services are expected to rise, which means it's a stagflationary risk environment. So given this stagflationary risk environment, the Feds are tight. It means the Fed monetary policy will be tight. That means, i.e., in the past, a slowdown in economic growth, the Fed could actually negate this slowdown in economic growth by cutting rates. But given the fact that right now we are now facing the risk of this, we call it two evils of economic uncertainty, slowdown in economic growth, followed by a potential further rise in inflation expectation or inflationary pressure. That means cost of goods and services will go up. So the Fed cannot actually use their monetary policy to their fullest potential. That means, yes, it cut rates to actually boost up economic growth, but in the meantime, it also lead to a rise in further inflationary pressure down the road as well for the US economy, because the US right now is facing the two evils of economic uncertainty, slowdown in economic growth, potentially also further increase in inflationary pressures or inflationary expectation. So if you look at the latest CME FedWatch 2, for those who actually have been following my daily dose on a very regular basis. So this CME FedWatch 2 is allow us to track market participants' expectation on future Federal Reserve monetary policy decision outcome. All right. So based on the Fed funds interest rate futures market. So the next meeting will be on this coming Thursday at 2 a.m. Singapore time, 19th of March. So US time will be at 2 p.m. Market is now assigning a high probability of almost 100% the Fed will not cut its interest rate at all. All right, for this coming month, so maintain it at 4.25% to 4.5%. And because of this stagflationary risk environment that could take hold in the US economy at this juncture, the aggregated probability that where the CME FedWatch 2 assign future probability based on the pricing of the we call it those future month Fed funds interest rate futures contract, it also assigning only 2 potential interest rate cut for 2025. So the next potential rate cut that the Fed may engineer likely to be coming based on the Fed funds futures market as compiled by the CME FedWatch 2 will be on the 18th of June as FOMC meeting with a high probability of 96% to reduce by 25 basis point to 4% to 4.25%, and also then thereafter they will remain on hold because 69% chance that we are on hold on the 30th of July meeting. And the next one likely may come in September over here, September at 91% chance. All right, 91% chance. Then thereafter will be on hold on 9th of October. Okay, 3.75%, and this is not higher, only about a 60% chance that the Fed may cut again on the 10th of December 2025 meetings, before 25 ends to bring it down to 3.5% to 3.75%. So higher odds that based on the CME Fed Watch 2, the market participants in the Fed Funds future contract is currently now assigning a higher probability of potentially 2 interest rate cut of 25 basis point each before 2025 ends. So that is also in line with the latest dot plot projection as being given by the Fed in the December FOMC meeting last year. So I'll talk more about the Fed dot plot projection as we head into this Wednesday FOMC meeting tomorrow. All right, and because of this stagflationary risk environment, we start to see gold prices rallied over here. So gold prices rallied and hit a fresh all-time high this week by hitting the 3,000 level mark over here. All right, so later I'll share with you what are the key levels to watch out for gold on a intraday basis for today in terms of the XAU/USD contract that we have in our platform. All right, and one more key data event that has taken shape so far on the weekend was China. So China, based on its local popular official Xinhua news agency, saying that the China top policymaker will take steps to revive consumption by boosting people's income. So that is also in line with the conclusion of the 2 session that was 2 weeks ago on the 1st week of March. We have highlighted to you guys. And very important today over here is that there is a press conference, all right, from top policymaker to be held at 3 p.m. today and to highlight the more concrete steps to boost domestic consumption. All right, so something to look out for. And as well as during the weekend, we start to see one of the China big tech, Baidu, start to release its own reasoning AI model to take on DeepSeek. Right, so DeepSeek is also a China startup. So based on the release of this DeepSeek reasoning AI model, where independent research that is almost on par with OpenAI, US-based ChatGPT, but operating at a lower operation cost. And because of this emergence of this China big tech reasoning AI model that runs on a lower cost than US-based OpenAI sparked outperformance and a rally in the China big tech stocks, having a positive feedback loop into the Hang Seng benchmark stock indices. So as we are speaking right now, the Hang Seng benchmark index is actually rallying up by 1.16%. The HSCI is up by 0.74%. The Hang Seng Tech a bit lackluster, negative 0.22%. So based on this 2 positive news flow, one up from Baidu new reasoning AI model, and as well as market is now anticipating a rather positive press conference that's going to be out soon as chaired by top China policy makers to actually highlight more concrete plans on how to boost domestic consumption in the Chinese economy at 3 p.m. Singapore time today, which is Monday. All right, and that should actually wrap up this news flow and economic data segment for today's daily dose. All right, so now with that, let me touch on the intraday technical outlook on the major cross asset classes, starting with the FX market first. All right, so before that, without further ado, let me expand my screen so that you guys can have a better view of the charts over here. Okay, let me expand my screen. Okay, good. Okay, so let me start with the FX market. All right, so before I start on the FX market or the individual FX pair, let's have a quick look at the 5-day rolling performance. So this is a very short-term trend on the US dollar against other major currency. So we start to see the dollar rallying against the yen and against the Swiss franc over here, but continues to actually kind of trade sideways against other major currency, like against the euro, the sterling, the Aussie, and the Kiwi as well. In fact, the dollar is actually underperforming the Aussie and the Kiwi at this juncture. All right, so there's some form of dollar strength coming back into the market, especially against the yen and against the Swiss franc. All right, so without further ado, now let us now jump straight into the intraday technical outlook on the major dollar pair, starting with the euro dollar. So on the euro dollar, I want to highlight on the longer term chart. So you know that the euro dollar has been rallying very strongly in the last 2 weeks or so because of German, we call it potential expansionary fiscal policy out from German to actually jumpstart the Eurozone economy. And that being said that because fiscal policy is getting more expansionary in Germany, which is a key Eurozone economic contributor, that potentially will start to take a bit of what you call it a leeway from ECB expansionary monetary policy. So ECB expansionary monetary policy can take a step back, being fulfilled by the Germany expansionary fiscal policy. So going forward, ECB may not be so aggressive in cutting interest rates, and perhaps markets looking at least one more interest rate cut for ECB for this year before they stampede. So that actually causes the euro to rally in the last 2 weeks. And this rally right now seems to be stalling at the 1.0885/1.0940 resistance level, which is the swing high area of 5th of November, and as well as the former major trend line support that I draw from the low of October 2023 now turns into a pullback resistance over here. And if you do the Fibo retracement of that previous multi-month down move from the high of 25th of September 2024 all the way down to the low of 13th of January this year, okay, it coincides very closely to the 76.4 Fibo retracement. So with that, we will have a neutrality stance for today on the euro dollar, given that it's playing around at this, is flirting around at a key medium-term resistance zone, as I shown on the daily chart. And if you look at the hourly chart, the hourly RSI continues to print a series of lower high, indicating a lackluster positive momentum as well. So we flip to a neutrality stance for today on the euro dollar. So neutral between 1.0940/0970, and the lower limit of the neutrality range will be 1.0810. However, if we start to see a breakdown below 1.0810, then potentially the euro dollar may trigger off a intraday corrective decline movement, exposing the next near-term support level in first step at 1.0730, which correspond to the 200-day moving average as well. All right, so i.e. Due to the daily chart right now, the euro dollar starts to stall at a key resistance level. On the intraday basis, we will flip to a neutrality stance for the euro dollar between 1.0940/0970 upper limit. Lower limit of the neutrality range for today will be 1.0810. Now, moving on, next will be the sterling dollar. So the sterling dollar continues to unable to see a significant breakthrough above our pivotal resistance I highlighted earlier before I went on a week-long leave last week at 1.2965, and it starts to kind of trade sideways thereafter. So still no change. 1.2965 will be the short-term pivotal resistance that I will use for today on the intraday basis, and in conjunction with the lower high that is being flashed out on the hourly RSI, indicating that lackluster positive momentum, there could be still a risk for the sterling dollar to shape that very short-term intraday corrective decline sequence on the intraday basis, with first near-term support coming in at 1.2870. A breakdown below 1.2870 may see the extension of today's intraday potential corrective decline sequence to expose the next near-term support level at 1.2810, which is also correspond very closely to the 200-day moving average. However, if we start to see a breakout and the hourly close above 1.2965, today's intraday bearish bias will be invalidated to see the continuation of this ongoing multi-week corrective, multi-week rebound or rally sequence towards the next near-term resistance level at 1.3025/1.3040. Above it sees the next resistance level, which is so confluence with a psychological level at 1.31. All right, so net overall, still maintaining that intraday bearish bias using 1.2965 as my short-term pivotal resistance level for the sterling dollar. Okay, onward next will be the Asia Pacific currency major dollar pair, starting with the Aussie dollar. So the Aussie dollar continues to trade sideways. Last week, it came down as expected before shaping a bounce, and this bounce can't surpass above the 63.60 short-term pivotal resistance level. So very likely it may continue to churn within this kind of sideways range configuration since hitting the 63.60 short-term pivotal resistance on 7th of March, okay, before I went on a short week-long break. So still no change using 63.60 as my short-term pivotal resistance level in this kind of very complex sideways range configuration. Still maintaining that intraday bearish bias for it to drift downwards towards the lower limit of this complex sideways range configuration, with two near-term support level to watch: 63 figure level followed by 62.80. So 62.80 also confluence with the minor swing low area of 13th of March, and as well as the 50-day moving average as well, acting as a similar support level at 62.80. All right, so I repeat, Aussie dollar may be evolving in this kind of sideways complex range configuration on the intraday basis, since it's 7th of March high, that is the 63.60 short-term pivotal resistance. So as long as 63.60 short-term pivotal resistance, which is the range top of this minor complex sideways range configuration, is not surpassed to upside, it may potentially drift downwards towards the lower limit of this minor complex sideways range configuration, with two near-term support level to watch: 63 figure followed by 62.80. Only an hourly close above 63.60 may see a squeeze up to revisit the medium-term pivotal resistance of 64 figure. So why 64 figure is important? Because we got 64 figure on the daily time frame is our medium-term pivotal resistance, which is the former major ascending trend line that I drew from the low of 13th of October 2022 low, broken down, and has a 2022 low over here. Now turns into a key pullback resistance level, and it was got rejected previously on the 20th of February. All right, so that's for the Aussie dollar. Onward next will be the dollar yen. So the dollar yen came down as expected over here, hit our support level at the 1470.50, 1470.40 level, which I highlighted before I went for a break, and right now shipping this kind of rebound. So where it hit, you also hit the lower limit of this medium-term descending channel that is in place since the high of 10th of January this year. So very likely right now, given that the hourly RSI continues to shape higher low and is now trending above the 50 level mark, indicating some form of short-term positive momentum is in play on the dollar yen, which means that it actually also supports this ongoing potential minor corrective rebound phase to retrace certain portion of this ongoing medium-term downtrend that is still in place on the dollar yen, because it's still trading below the 20-day and the 50-day moving average. So using last Thursday minor swing low area, we also correspond very closely to this minor ascending trend line that I drew in gray, that I drew from the low of 11th of March. 14,760 will be my short-term pivotal support level to flip to a intraday bullish bias for this ongoing minor corrective rebound phase to play out. Near-term resistance level to watch: 149.20. Above it sees 150 figure level next over here. However, if price action starts to plummet down and have an hourly close below 147.60, today's intraday bullish bias for that minor corrective rebound sequence will be invalidated to see the continuation of the impulsive down move of the medium-term downtrend phase to resume. First support level to watch will be 147.50/25, which is very close to the minor swing low of last Tuesday. Below it exposes 145.10, 145 figure next. So i.e. flipping to a intraday bullish bias for a potential minor corrective rebound phase to play out on the dollar yen, using 147.60 as my short-term pivotal support level. All right. Now moving on, next will be the major major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hang Seng Index managed to actually shape higher after yesterday's whipsaw. Last week whipsaw, So last week whipsaw managed to actually store and rebound right exactly at the 20-day moving average, and also the lower limit of this medium-term ascending channel drawn from the low of 10th of January this year. So first near-term support level to watch will be 23,830, which was the minor range top of last week congestion, now turns into a pullback support because it hasn't surpassed above the previous we call it a swing high of 7th of March at 24,510. I do not want to tighten my key short-term pivotal support level to be so tight at 23,830, so I'll use 23,290 as my short-term pivotal support for today, having a bullish bias on the intraday basis for the Hong Kong 33. Above 24,510 exposes the next near-term resistance level at 25,080 next on the Hong Kong 33. However, if price action suddenly just plummet and have an hourly close below 23,290, then this Hong Kong 33 may start to shape a minor corrective decline sequence, exposing the next near-term support next at 22,470. Below it, may see it plummeting down further towards 21,630, which correspond to the rising 50-day moving average as well. So i.e. still having a bullish bias stance on the intraday basis for the Hong Kong 33, representing the Hang Seng Index, using 23,290 as my short-term pivotal support. Now, next up will be the Japan 225, representing the Nikkei 225. So the Nikkei 225 plummeted down as expected, and right now is actually shaping a corrective decline, a corrective rebound, pardon me, and this corrective rebound now is fast approaching the 20-day moving average, a downward 20-day moving average, and also the former minor swing high of 6th of March that kickstart that previous last down leg on the Japan 225 that came in without expectation before I went on my week-long leave. So with that, using a slightly adjusted short-term pivotal resistance for today, 37,830, having a bearish bias stance on the Japan 225 for today. First near-term support level to watch over here will be 36,830, also being supported by the hourly RSI hitting the overbought level and has starts to exit from the overbought level with a bearish divergence. Okay, there's a bearish divergence over here, lower high. Okay, if you could see. Okay, so flipping to a intraday bearish, having an intraday bearish bias on the Japan 225 using 37,830 as my short-term pivotal resistance. First near-term support level to watch, 36,830, which also confluence with the minor ascending trend line that is still in place since the low of 11 March. Only a breakdown below 37,830 on the intraday basis for today may open up scope for further potential weakness on the Japan 225 to expose the next near-term support zone at 36,450/36,220. Only a push up and an hourly close above 37,830 for today will invalidate the intraday bearish bias to see the extension of this minor corrective rebound phase to seek out the next intermediate resistance zone at 38,325/38,490, which will correspond very closely to the 200-day moving average and the downward sloping 50-day moving average as well. So that's the intraday technical outlook on the Japan 225, still having a bearish bias using 37,830 as my short-term pivotal resistance level. Up next will be the German 30, representing the German DAX. So the German 30 last week have a bit of whipsaw at the 20-day moving average, but still managed to hold above the lower limit of this medium-term ascending channel that I drew from the low of 13th of March. All right. So with that, I'll be using the 20-day moving average, also correspond to last week minor range top of that whipsaw at 22,740, having a potential bullish bias for today on the intraday basis. First resistance level to watch will be 23,220. Above it, potentially seek out the next near-term resistance level at 23,600, being defined by a Fibo extension cluster, which also confirms very closely to the current all-time high at 23,482. Only a push down and hourly close below 22,740 will invalidate today's intraday bullish bias to kickstart another round of whipsaw and to have another round of whipsaw formation again, revisiting last Thursday and Friday swing low area at 22,440, which is the lower limit of this medium-term ascending channel as well. Only a breakdown below 22,440, the German 30 will face a risk of a minor corrective decline sequence to unfold, exposing the next near-term support level at 22,120, which is corresponding very closely with the rising 50-day moving average. So that's for the German 30, using 22,740 to have a bullish short-term intraday bias for today. Now, next up will be the major US stock indexes, starting with the US Wall Street 30. So it plummeted as expected over here and hit our support level that I highlighted earlier on 7th of March and continues to show signs of weakness. Hourly RSI has flashed a kind of a bearish divergence as well over here and continues to print lower high. All right, so and right now is hovering at the upper limit of this ongoing minor descending channel that I drew from 3rd of March. So first resistance level to watch out for today at 41,450. I don't put it so tight. I'll use it slightly higher, 41,770,980 as my short-term pivotal resistance level. We also correspond to the 200-day moving average. Maintain a intraday bearish bias for today on the intraday basis for the US Wall Street 30, representing the Dow Jones Industrial Average. First near-term support level to watch will be last Friday minor swing low at 40,065. A breakdown below it exposes 40,230, which 43,230, yeah, which represents a Fibo extension cluster level. All right, and also very close to the lower limit of this ongoing minor descending channel that I drew from the high of 3rd of March. Only an hourly close above 41,980 for today will invalidate today's intraday bearish bias to kickstart a minor corrective rebound sequence for a mean reversion rebound sequence to expose the next near-term resistance level at 42,490. Above it may see a further retracement towards the downwards 20-day moving average at 42,980/43,120. So still having a potential bearish bias stance on the intraday basis on the US Wall Street 30 using 41,770/41,980 as my short-term pivotal resistance level. Onward next will be the higher beta Nasdaq 100 index. So it plummeted as expected as well, hit our support level at around the 19,800, 19,700, which I highlighted on 7th of March right now, and it starts to shape that corrective rebound in a rather sideways rangy configuration. Hourly RSI also shaped that bearish divergence as well, over here representing a lackluster momentum reading on an hourly basis and continue to shape lower high, which represent further weakness on the Nasdaq 100. So using a rather tightened short-term pivotal resistance for today, 19,840/19,910, still maintain that intraday bearish bias on the Nasdaq 100. First near-term support level to watch will be 19,125, which is the lower limit of this sideways corrective range configuration. A breakdown below 19,125 exposes the next support level at 18,840 in near term /18,820, which is a 1.236 extension level as well. Only an hourly close above 19,910 will invalidate today's intraday bearish bias, only a break above 19,910 and hourly close above it will invalidate today's intraday bearish bias on the Nasdaq 100 to shape a minor corrective rebound sequence, exposing the next near-term support resistance level, at 20,340, which correspond to the 200-day moving average. Above it sees a further extension of the minor corrective rebound or mean reversion rebound sequence towards the next near-term resistance at 20,720, which will correspond to the downward sloping 20-day moving average. All right, so that's for the Nasdaq 100, still maintaining that intraday bearish bias using a tightened short-term pivotal resistance level at 19,840/19,910. All right, so we covered the much ground on the short-term intraday technical outlook on all the major stock indices. So let us now focus our attention to the commodity asset classes, starting with Gold XAU/USD. So Gold XAU/USD hit 3,000 level. So that was the resistance that we highlighted on before my week-long break. So with that, the hourly RSI also continues to actually has already exited from the overbought level, and right now potentially there's still an ongoing ascending trendline support that is still supporting the hourly RSI over here. So there could be some form of push down on the hourly RSI hit to retest very closely this ongoing minor ascending trendline support. That means i.e. there could be a bit of pullback taking shape over here. That is still intact, but this minor pullback potentially to maintain its intraday bullish momentum on the Gold XAU/USD, it shouldn't break below our new tightened short-term pivotal support level for today at 2,954. Also correspond to the Fibo retracement of 38.2%. All right, 38.2% Fibo retracement as well. Right over here. Okay, 38.2% Fibo. Oops, let me highlight. Right. Okay, 38.2% Fibo retracement. Right. So as long as this minor pullback that could take shape right now, because the hourly RSI is still showing potential of that minor pullback. So as long as this minor pullback didn't surpass below our tightened key short-term pivotal support that I have for today, 2,954, which also correspond to the previous all-time high area of 20th of February and 25th of February. potentially gold XAU/USD may maintain its intraday bullish bias to seek out the next intermediate resistance level defined by the 1.382 Fibo extension taken from the low of 28th of February to a new fresh all-time high at 3016. Above it sees 3030/3040, which is the 1.618 Fibo extension as well. However, only a breakdown in the hourly close below 2954 short-term pivotal support level for today will invalidate today's intraday bullish bias to kickstart a minor corrective decline sequence for a further potential retracement towards the next near-term support level at 2923, which corresponds to the 20-day moving average. A breakdown below it may see a further potential dip down to revisit last Wednesday minor swing low at 2906. So i.e. in a nutshell, yes, there may be a bit of minor pullback that may take shape on the intraday basis for gold XAU/USD, but overall the technical factor still remains positive for this ongoing minor intraday uptrend. So using 2954 tighten short-term pivotal support level for today to maintain the intraday bullish bias for gold XAU/USD. All right, so onward next, lastly, will be the oil, West Texas crude oil over here. So West Texas crude oil, before I went on leave, we do expect a minor corrective bounce, and the minor corrective bounce within this medium-term downtrend phase has really hit the resistance level almost very nearby. Okay, we have 68.80. So on a Friday, today's Asia session, it hit a high of 68.46. All right, so using 68.80 as my short-term pivotal resistance level also correspond to the downward sloping 20-day moving average and the upper limit of this medium-term descending channel that I drew from the high of 16th of January. We will flip back to a intraday bearish bias for West Texas crude oil. First near-term support level to watch will be 66.45. A breakdown below it exposes the medium-term range support level, which is confluence with the 6th of March and 11th of March minor swing low area at 65.70/65.40. Only an hourly close and a push up above 68.80 short-term pivotal resistance for today will invalidate today's intraday bearish bias to see the continuation of the minor corrective rebound phase extending up towards the next intermediate resistance at 69.50. Above it potentially sees 70.80 next as well. All right, so that's for West Texas crude oil, still flipping to a intraday bearish bias for today using 68.80 as my short-term pivotal resistance level. All right, so that also sum up the intraday technical outlook on the major broad-based cross asset classes. So before we go, let's have a quick look at today's economic calendar. So other than this, I highlighted earlier at the start of today's daily dose at 3 p.m. Singapore time, this news will be out from China, where China top policymaker will hold a press conference to highlight potential further steps or detailed steps to boost domestic consumption. So that will happen at 3 p.m. Singapore time. So other than this key China event, what other event to take note of for today? Over here, so for today, over at the US session, we do have one key US economic indicator, which is retail sales, will be out at 8:30 p.m. Singapore time. So on a year-on-year basis, market is expecting okay, there's a forecast by Trading Economics to be lackluster, 3.5% year-on-year from the previous month of January at 4.2%. All right, year-on-year. Then at 10 p.m. Singapore time, we have ECB President Lagarde speaking that may influence the movement of the euro dollar and the euro crosses. And thereafter will be a rather quiet US session. And in tomorrow Asia session, very early at 7:30 a.m., RBA official Hunter will be speaking that could potentially impact the Aussie dollar and the Aussie cross pair. Okay, so with that, that sum up today's daily dose of market insights. Do have a great day ahead, and we shall speak again tomorrow. Thank you.